taxpayers, mate, a lot of you. This is our country. You should be here standing with us. So migration is a touchy subject in the UK right now. And here is something that you might not know. According to the ONS data, 517,000 people left the UK in 2024. And that's an 11% jump from the year before. And early signs already suggest that even more people will leave in 2025 and beyond if things continue as they are. Now, some of these people are millionaires with accountants handling everything for them.
Super wealthy have begun leaving the UK.
10,000 millionaires,
billionaires and millionaires like us that are leaving the country.
But many of these people are ordinary people, and I mean doctors, teachers, even content creators, people with options that are living for reasons like better taxes, better weather, safer streets, lower cost of living, or maybe simply feeling unappreciated in the UK. That's why they've left. Now, this isn't a political video, right? The real question that I want to answer in this video is what happens to your ISA, your pensions, your property, or even your investment when you actually leave the UK? Is this something that you've considered? And if that's not the case, let's jump right in because that's what we'll answer. So why does this even matter? That's because when you leave the UK, your money doesn't just follow you as smoothly as some people think. Maybe if you have everything in a savings or current account. But if you have an ISA, property, pensions, investments, or even crypto or gold, each piece of your finances actually play by different rules depending on your residency situation. With regards to residency, you really want to answer just one question. Are you considered a tax resident in the UK and also in the country that you're moving to? Because residency is what sets the rules. Now, depending on where you go, the details will change. But here are the most common UK scenarios. Scenario 1, you stop being a UK tax resident and become a tax resident of the country you're moving to. That's a clean break. But you have to pass certain tests before you can say you've left the UK for tax reasons. The simplest ones are if you spend less than 183 days in the UK in a year, you're probably not a UK resident, or you're probably not seen as a UK resident. Another test you can quickly do is if you work full-time abroad and spend fewer than 91 days in a year in the UK. There are other conditions about your home, visits, ties, but you don't have to worry about that. I'll link an HMRC test link in the description so you can check for yourself where you fall into. The second scenario is a split year. So part of the year you're taxed as a UK resident and the other part you're taxed as a non-resident. That usually happens if you move mid-year abroad. And this is usually handy because it just keeps things clean and not messy. The third residency situation or scenario is temporary non-residence. And that means you're leaving the UK, but then you come back within 5 tax years and HMRC can claw back tax if that is what you do or what you're planning to do. And finally, you have dual resident lifestyle. Summers in UK, winters in Dubai or Spain. That doesn't give you a free pass. Both countries might actually try to tax you at the same time. And then it comes down to tax treaties, who decides who gets your tax and all of that. Understanding which scenario applies to you actually matters because it sets the rules for what happens to your ISA, your pension, your property, and all the other investments that you have. And that's exactly what we're going to be breaking down. Let's start with your ISA. Now, your ISA doesn't disappear when you leave the UK, and that's good news. You can keep it open, you can keep it growing tax-free, at least from the UK's perspective, and that's very important. But here's the catch that no one will tell you. Once you're a non-resident, you can't add new money to your ISA account. The only exception are those of maybe the Crown employees working overseas or their spouse and civil partners, in which case they can continue contributing. So you can think of your ISA like your ISA have been paused. Whatever you've contributed into the account, keep compounding and keep growing from a UK standpoint, tax-free. But where it gets tricky is that some providers won't let you keep an ISA at all once you've moved abroad. So before you leave, maybe you want to call your ISA provider and ask, Can I keep this account open as a non-resident and all of that, and get a clear answer? But remember, your ISA's tax shield only work in the UK. If you move to, for example, Spain or Canada, the tax authorities there can treat your ISA as a normal account and tax you on that. You can keep your ISA, but the magic depends on where you live next, the country that you move to. They will determine what happens to your ISA. The second is your pensions, right? This is where people panic the most, and for good reasons, right? So will you get your pension abroad? The answer is yes. Your workplace and personal pensions are yours no matter where you live. But the real issue is tax. Your pension income is UK sourced. That means that the UK could tax it, and your new country might want to tax it too. That's double taxation. Thankfully, most countries have treaties with the UK to stop that double taxation. Usually, your country of residence gets the right to tax your pension. So you can apply to HMRC to have your pension paid gross, no UK tax taken. But there is a twist with that, the 25% tax-free lump sum. In the UK, you can take that tax-free, but abroad, that's not always the case. So if you take, like, for example, a £50,000 lump sum while living in, let's say, Australia, the Australian taxman may say they don't see it as tax-free and they will tax you. So you need to be conscious of this and know what the rules are for the country that you're going to before you actually leave. Now, what about state pension? Yes, you can also claim your state pension abroad, but there is a twist to that. For some countries, your state pension is frozen at the point you're leaving. For example, if you move to Canada, your state pension won't increase by the triple lock. So it's going to be frozen in 5 years' time, 10 years' time, 20 years' time, you still get the same amount of money. There are thousands and maybe even millions of British pensioners that are stuck on what they were collecting 10 years ago, while their mates in the UK have had an increase in their state pension over those years. So it's very important to be informed. Check the destination, check whether you would benefit from any increase as a result of the triple lock when you move, because that one detail alone will cost you thousands over the years. If you're finding this helpful, please do me a quick favor, hit the like button. It helps this video to reach more people planning to move abroad. And it also tells me to make more videos and guides like this. Also, please share with people that you know that are planning to move abroad. The third investment that we'll look at is property. The question now is, do you sell before you move abroad, or do you keep it as a rental investment? Legally, there is nothing that forces you to sell when you want to move abroad. Many expats actually keep their property for security or rental income, but what you need to know is that HMRC will still get its cut. Now, if you decide to sell, since 2015, non-residents pay UK capital gains tax on property sales. But here is an important nuance that you need to know. If the property was your only and main home, you may qualify for private residence relief, which often exempts you from paying tax. For example, you live in the house the whole time you were in the UK and you sold it within 9 months of moving to your new country. Usually, you won't pay any tax. If you keep the house for a longer period after you've moved, or maybe you rent it out, some of the gains might be taxed. So it's not a blanket rule. Check your status very carefully. I would also leave an HMRC link in the description so you can run the test for yourself to see where you stand. You can't escape HMRC with your property. Your property remains taxable in the UK. And that's why many people weigh up the option of, do I keep it for rental? Do I sell it? Either way, you're going to pay tax one way or another, unless if it's your main and only home and you sell it within 9 months of moving out of the UK or being a non-resident. Now, as for your other investments, your shares, funds, whatever it is, once you're a non-resident, the UK generally doesn't tax you on your stock sales or dividends. Property is the exception, but that's always taxed. But your new country will probably have the burden to tax you, not the UK. If you live in Spain, the Spanish government will tax you. You will go by the Spanish rules. If you live in the US, the IRS will. But here's the hidden trap. The temporary non-residential, I mentioned that before. If you leave the UK, sell a load of your assets and your shares, and then you move back within 5 years, HMRC can actually retroactively tax the gains that you've gotten from your stocks and your shares. That's their way of actually stopping tax holiday tricks. So don't bank on quick exits. Plan for actually the long term. Also be ready for practical hurdles. Some UK brokers won't let you keep your account when you're abroad. We've mentioned that with the ISA. It happens with some other accounts also. You might also be restricted to selling your shares, or worse, you might be asked to close your account because you're not a resident. That's why people actually switch brokers when you're ready to move. You move to a broker that would allow you maintain your account abroad. So now let's recap this whole video. Your ISA stays, but you can't add to it. Your pension, you can put taxes, will depend on the country that you go to. Property, most times, is always taxable unless if it's your main residence while you are living in the UK. So the big lesson here is don't lose your money when you leave. Without planning, you could lose thousands of pounds in surprise taxes. Now, I want to hear from you. Where are you moving to? And what's your biggest financial worry moving to that country? Drop your answers in the comment section. I read every comment and I respond. And I hope this has been helpful. If it has been helpful, once again, hit the like button and subscribe for more videos like this to help you level up your finances. Until next time, keep getting better.